This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Corporate governance is a system by which companies are directed and controlled. And it used to be, historically speaking, that the only real check on how companies were being governed and controlled was that every year financial statements were produced, they were audited, distributed to the shareholders, and that was the shareholders' chance to see what was happening in their company and how the directors were actually performing. The directors would hold board meetings. That was how they're supposed to be controlling the company. But one of the abuses was that if you had a very powerful director, what they would do is they would go round each of their other directors, kind of one-to-one conversations, get them on side, and then when it came to a board meeting, everything had kind of been pre-agreed. The way auditing came into it was that the company is owned by the shareholders. So they own the company, but the directors manage it. And this is sometimes called an agency relationship. The shareholders are what's known as the principals, and the directors are the agents. And as a matter of law, the agents should be acting on the best interest of the shareholders, but often they didn't. The directors prepared the financial statements. This would allow the shareholders to see what the performance was. The auditor would add credibility. The auditors were appointed by the shareholders and report to the shareholders. But a year between these financial statements being prepared, perhaps longer than a year, gave the directors lots of opportunities not to act in the shareholders' best interest, but in their own self-interest, really to enrich themselves. So this principal-agency relationship is one way of looking at it. You may sometimes see the concept of stewardship. Stewardship is the idea that the directors are stewards of the company and its assets. They should be looking after the company and its assets on behalf of the shareholders. And again, that was found to be lacking. And it was in particular in the 2000s that things came to a head. In the early 2000s, we had big scandals like Enron and WorldCom. In around 2008, we had Lehman Brothers, a large bank, going bust. And these were large, if you like, pretty well-regarded companies. They'd all been audited fairly recently, yet they went into liquidation very, very precipitously, causing ruin to many investors and employees. And people said, something has to be done. So how is corporate governance now achieved? The first thing to look at are the principles set out by the International Corporate Governance Network, or ICGN. This is an international organization, as it suggests, with many large companies, professional bodies, firms of accountants as part of its membership, and they've tried to get a kind of universal approach or principles to good corporate management, corporate governance. Now, I don't think in the exam you'll ever be asked to list all these principles, but you need to know the gist of them. You may be asked to criticize a company and its corporate governance because perhaps it doesn't live up to some of these principles. So very quickly, there are some more detailed paragraphs in the notes. It looks at board role and responsibilities. And it says that the board should promote long-term best interests of the company by acting for the benefit of the shareholders and having regard to relevant stakeholders. This idea of long-term is a recurring theme in modern corporate governance. Leadership and independence. Board leadership requires clarity and balance of the board and executive roles. It requires them to look at the long-term success of the company. Composition and appointment. There should be a mix of directors, both executive and non-executive, with the relevant knowledge, independence, competence, industry experience. And they should each be able to properly challenge and question board decisions and to give advice. The corporate culture. The board should encourage proper behaviour within the company and all its employees. High standards is important. Remuneration. Remuneration requires a balance and equity between the directors and the shareholders and the employees. The more one group gets, the less the other is going to get. But it does recognise that to have long-term success of the company, you have to have good management, and they have to be paid appropriately. And again, it talks about long-term sustainable value, preservation and creation of value in the company. Risk oversight. Very importantly, the directors should look at risk, they should look at internal control procedures, and you need a balance between risk and entrepreneurship. If you wanted no risk, you could put all the money into a large bank deposit account, but it's only going to earn a relatively low percentage. Once you want something more exciting, you tend to have to go for a more risky undertaking, but they have to balance that and also to look at what the risk appetite of the shareholders might be. Corporate reporting. Board should oversee timely and reliable company disclosures to shareholders and relevant stakeholders. Internal and external audit. We know external audit is important to give an independent view, if you like, of the truth and fairness of the financial statements, but internal audit has a very important role to play in corporate governance. Shareholders' rights. All shareholders should be treated equally and should be protected. It would be wrong for the directors to devolve some sort of scheme which effectively made the shareholders powerless or made one section of the shareholders powerless and placed them at a disadvantage. And shareholder meetings. Board should ensure that meetings with shareholders are efficiently, democratically and securely facilitated to enable constructive interactivity and accountability. Again, this shareholder involvement is very important. After all, at the end of the day, the directors and the board should be acting in the best interests of the shareholders. We've mentioned this already a little bit in ethics, two approaches to corporate governance and ethics. We had the rules of compliance-based approach. The country which has adopted a particularly rules-based approach is USA, and they have the Sarbanes-Oxley Act, which means that if you're going to be complying with corporate governance in the USA, basically you have to sign off a lot of procedures that this has been done, that has been done, etc. And very particular audits that the directors have done what should be done under the corporate governance rules and so on. The auditors also have to sign off. If people sign off these documents without due care, then there can be criminal sanctions brought against them. In most of Europe, we have framework and integrity based. The emphasis is on managerial responsibility and a proper ethical approach and proper corporate cultures. In the UK, its framework is imposed by the stock exchange, and they've taken the view that you should comply with a framework, or if you don't comply with it, you have to explain, you have to disclose and explain why not. Corporate governance, the way in which it is kind of exercised, often divides into two approaches in the board, unitary and two-tier boards. Germany, for example, has gone for the two-tier board approach, where you have a supervisory board, which is not taking day-to-day decisions on the running of the company, but supervises the management board, and in particular, it's going to be looking very closely at long-term strategic decisions. The management board takes the more day-to-day decisions on maybe what products to produce, to withdraw, etc., going on like that. Employee type decisions, reorganization maybe of departments. So you've got the supervisory board particularly looking after the long-term sustainability and strategic decisions, and it's supervising the management board who has the, as I say, more day-to-day decisions. Information has to kind of go both ways. You have to have good communication upwards here of information, reports, results, proposals, so that the supervisory board can do its work. And then you have maybe requests for more information, judgments, warnings, control and so on, going down the other way. There are disadvantages and advantages in both sorts here. Let's just look at a couple of on either side here. Potentially, having the two-tier system here means we can have slower decisions. If you want to take over another company, that'd be very much a strategic sort of decision, but sometimes the time gap you have available for taking over a company is quite short. You have to go in quick, and potentially having to report up to a supervisory board, have it decide its views and then kind of report them back down, can introduce delays. Information flows could be poor, either, I suppose, deliberately or accidentally. The supervisory board may not properly understand or appreciate what the management board is actually doing. On the other hand, the two-tier board gives much greater independence. They will meet, they can discuss the almost higher level issues amongst themselves, almost in privacy, without maybe interference and pressure coming from the management board. And a clear separation of roles can be important. A unitary board has been taken up, say, by the USA and, say, Britain. There is one board, but within that one board you have got both executive directors and non-executive directors. Potential disadvantages here, it can lack clear division of responsibilities in some cases. You have your executive directors sitting amongst the non-executive directors, and there's a potential of the executive directors bringing some personal pressure to bear on the non-executive directors, maybe in some cases getting on to an almost kind of bullying within the single tier board. On the other hand, everyone knows what's going on here. In a way, there's almost much less need for communication, because communication is going to happen in this single forum, and will allow fast decisions to be made. Only one vote is needed. There's no toing and froing of information flowing up and down and so on. Now, the ICGN, the International Corporate Governance Network, does not directly impose its principles on each country. Each country is free to really develop its own rules. And in the UK, which we can use as a model, this is found in the UK Corporate Governance Code. And there are 5 headings: board leadership and company purpose, division of responsibilities, composition, succession and evaluation, audit risk and internal control, and remuneration. Let's look at these in turn. Get this to move. There we are. Board leadership and company purpose. There has to be an effective and entrepreneurial board looking for promoting long-term sustainable success. They have to have adequate resources. They must take into account risk, a balance between entrepreneurship and risk. They must engage with stakeholders. They must set, if you like, the ethics of the company and ensure that as we go down through the company, there are consistent values met at every level. A division of responsibilities. The chair leads the board. The chief executive looks after the day-to-day running of the company. And these are split. You cannot have the same person being both. There should be an appropriate balance of executive and non-executive directors. Independent non-executive directors should be at least twice, or a big one, at least 50%, over 50% of the total board number. The non-executive directors must have time to fulfill their functions, and they should be of such a calibre that enables them to challenge, give proper strategic guidance, give advice to the executive directors. With a secretary on the board to ensure that company has policies, resources, processes which are efficient and effective. Composition, succession and evaluation. Appointments at this highest level, they have to be appointed by a formal, rigorous, transparent, independent, proper process. You can't have a director simply appointing their best friend or somebody they happen to know from 2 jobs ago. The job should be advertised, people should be interviewed, there should be a proper nomination, and that is looked after by the nomination committee. The board should be regularly refreshed. People should have the right skills, experience and knowledge. There should be annual re-election. That'll keep the directors on their toes. And there should be an annual evaluation both of the board's performance and the performance of individual directors. Audit risk and internal control. Formal, transparent processes, independent, effective internal and external audit functions. There should be an audit committee. The audit committee will liaise with both internal and external audit. There should be a fair assessment of the company's position and its prospects. Ideally, of course, the financial statements would do that. And they have to establish procedures to manage risk, to identify it, decide how they're going to react to that risk, to oversee internal control, identify the principal risks that they need to suffer to achieve long-term strategic objectives and obtain that balance between profit-seeking and performance and risk. And finally, remuneration. This should support the long-term strategy of the company and should lead to sustainable success. Notice it should be linked to successful delivery. Some sort of profit-linked or share option scheme is really what's required, rather than a flat, static remuneration scheme to directors. If the company doesn't do well, they shouldn't either. There should be a remuneration committee led by, comprising non-executive directors. Should support long-term shareholdings by the directors. No director should be involved in setting their own remuneration. And as I said before, there's this balance to be obtained between recruiting and keeping and rewarding the directors, having enough wages and salaries for employees, and having enough profit left over that you can reward the shareholders. In summary, the gist or main thrust of both the ICGN principles and the UK Corporate Governance Code are as follows. Long term keeps coming back. Risk, return, entrepreneurial approach. Directors' remuneration linked to long-term company performance. Risk, identification, assessment, management, internal control required to have the controls to identify and limit our exposure to risk. A dissemination of power. The chairman separate from the chair, separate from the CEO. The non-executive directors, at least 50% of the board, there to challenge, give advice to the executive directors. This dissemination of power, so one person or group of people cannot have too much power. 3 committees: nomination, remuneration and audit committees. And finally, engagement of shareholders. The company is owned by the shareholders. Ultimately, it should be run by them. You have to have honest and frequent engagement with them. We have got commercial companies and we have not-for-profit companies, public sectors and NGOs. We're particularly thinking here of public sector governance, councils, government departments, maybe companies which are in public ownership there. Governance of those tends to be rather more difficult if you say take the governance of a hospital, the governance of a school. Rather more difficult because with at least a private commercial company, we know what it's there for. We know it is there to produce profits and to boost the long-term value of the company, often reflected in the share price. But what is the proper objective, say, of a hospital? Okay, you might say it is to cure people, but then you say, well, how much resource should it give to people with heart disease and people who need new hips and so on? You say, should it have any role in society to do research and development and clinical trials? You say, should it run programs to prevent disease or to screen people for early signals of the disease and so on there? You have multiple objectives, a whole lot of things to be keeping going, which makes it a little trickier. Setting and measuring the outputs can be quite difficult. How many new discoveries should a hospital produce in a year? How many new treatments should it discover? How many people should it recall for scans and so on to see if it can pick up disease earlier? What should the output be of people with heart transplants? What sort of success rate? How many should we afford versus how many hip replacements should we afford? They're working for financial constraints, and very often the financial constraints they can do very little about. The financial constraints here are often given by government. So it's not like a private kind of or your listed commercial organisation, where if it needs more money, it can put up a case for that and go out and raise more loans or to issue rights issues and so on, and get people to invest. And very often in public sector organisations, the government plays a bit fast and loose. It will suddenly cut away the amount of money available to parts of the public sector because it has other priorities coming in, maybe because there's an election coming up. There are political, social, legal considerations. We can be under emphasis or under a lot of pressure, maybe from press comment, from social media, and so on. There's little competition. How do we know how well a school is doing or a hospital is doing unless we see it competing, not necessarily, or at least get benchmarks to see how well it is using the money which is being given to by the government. You might be able to do it with different hospitals, but in some government departments it's going to be very difficult to judge, say, how the Home Office is doing or how the Foreign Office is doing or something like that. Should it be more careful with the amount of money it's giving to embassies and the like. No profit motive, not of itself a bad thing, but it can make the people in the business perhaps not seek efficiencies. It can make performance maybe a little bit harder to judge in sometimes. The 3 E's is a useful way maybe of getting into public sector governments. The 3 E's says, first of all, you should look at the efficiency, the effectiveness. And effectiveness is saying, does the public sector organisation do what it is supposed to do? How effective is it at, say, curing people of disease? And some procedures will decide not to do. So in the UK, the National Health Service says we're not really into cosmetic surgery. We're not helping people, improve how they think they look, particularly. That's simply not part of our remit. We'll be looking, however, at effectiveness in curing diseases. And then you say we can look at efficiency. So having decided that you're going to cure people of a disease, there may be 3 or 4 different treatments we could use, we should be choosing the treatment which is most efficient, given maybe some sort of balance between the outcomes, the way people are actually cured, and the cost of actually getting those outcomes. And finally then there is economy. Having decided how you're going to carry out a particular treatment, maybe which drug you're going to use, then it makes sense to go to the drug manufacturers and get a really good deal for them. Buy in bulk. Maybe make it a performance-related payment so that the drug company only gets paid on the basis of people who are cured. If you like, almost an ordinary commercial type of approach. The public sector performance matrix is shown here, which may or indeed may not give some guidance to local and indeed central government about how it should proceed with certain initiatives, certain types of expenditure. And it looks at the value for money and, in a way, how much the public treasures the particular public service. So if we had something which is very good value for money and which the public really appreciate, then any sensible politician will go for that. For a relatively little bit of taxpayers' expenditure, or a small amount of taxpayers' money being spent, we're doing something which the public like. which may or may not be of value, but at any rate the public like, and it's going to help you be elected again. So that is a public sector star. If you have something which is of low value money, quite expensive, quite difficult, taking a lot of revenue from the taxpayer, and we're not getting very, yet nevertheless the public seems to treasure this in some way, we've got quite a difficult one going on here. How should we handle that one politically? And one way might be to try to educate the public, to try to say, look, this is not a good way of spending your taxpayers' money. Why do you like it? Why do you think it's attractive? And some governments might think of what's known as hypothecating tax. They say, right, if you want the government to do this, we will raise a particular levy to do that. We'll use this money to pay for that public service. And this tends to bring it home to people. Okay, you can have this public service which you like, but it's costing a lot of money. Do you still really like it? Here's pretty easy. It's bad value for money and nobody's interested anyway, so just kind of get that off the agenda. That's not great. If something is good value for money, but the public aren't very interested in it, there's a slight bit of a dilemma there. If the public's not interested in it, maybe we could abandon it. Or what we could do, if we think it's good for the public, it's good value for money, maybe we can educate the public. We can say, look, for spending a little bit of money, we can maybe put in this form of, medical type of intervention. And look, think about it again. Wouldn't you want that? Don't you think that's a really quite good way of spending moderate amount of tax revenue?